Welcome to our webinar today on understanding financial and tax due diligence services. My name is Chasz Coulsting. I'm a director in the corporate finance team at Jerroms Corporate Finance. And today I've got with me Nick Wright, who is a director in the Jerroms Miller specialist tax team.
Hello.
And being a specialist on tax, he can talk to us on the tax issues and the tax due diligence side. So I thought we'd kick off with what is due diligence. So due diligence is essentially an investigation. So it's a sort of uncovering sort of on the financial side of a business or the tax side of a business, kind of trying to uncover the skeletons in the closet, or doing investigations into certain aspects, or trying to determine whether the profit of the business is as it seems on the surface. Why do we do diligence? Nick, have you got any thoughts on that? Or?
Yes, and it's not just why do we do it, when do we do it, and all the rest of it. And I mean, you mentioned financial due diligence and tax, which is what we're talking about. Obviously, there's legal due diligence as well.
Yeah.
So when we're doing tax due diligence, sometimes we'll pick up things like share history and stuff, where actually that's a crossover with the legals as well.
Yeah.
So you're basically just trying to look at everything in the history of the company, not necessarily. Normally we go sort of 6 or 7 years back, don't we? But there are certain cases when we might go even further back. And we're basically trying to make sure that what the buyer thinks they are buying and the price that they have offered to buy it for is
right.
as accurate as possible.
Well, I suppose, which comes to, I guess, who do we do diligence for?
Yeah.
I guess is a good way of answering why we do diligence, I suppose. So I guess a lot of times I do diligence is for, mainly for corporate acquirers. So when one business is buying another, I also got to do it for private equity. So when they're looking to invest into a business, or one of their portfolio businesses is buying another one. I guess also do it for banks as well, where maybe they're supporting an acquisition, or they're actually making a lend into a business,
because they obviously need to make sure that they're taking security on a loan, for instance.
They're taking security on a loan, and they want to know that the business kicks out the right level of cash flow and profitability to support their repayments. I guess it's also looking at the underlying assets to make sure they are on the balance sheet.
I mean, we do on occasion some due diligence for non-corporates.
Yeah. Okay.
I think the problem in terms of the level of work we do is generally non-corporates are not high-value transactions, and therefore the level of due diligence they require is perhaps not as high in terms of value and so we're always trying to justify the value we deliver. We're doing this due diligence to make sure that you've got you're not going to lose value.
I think sometimes with that, it's hard for people to see the value of DD until it's actually been done, or until they bought the business or made the investment, and then actually they've found an issue post the event. And I guess I say coming to the question of why. Why do it? Well, if you find an issue post-event, it's much harder to put right, or you've already committed your funds. Whereas if you find something pre-due diligence, you can assess, is that something I can rectify, or the sellers can rectify prior to completion? Yeah. Is there, some way we can adjust the deal or the mechanism or the way that,
Have you ever done any deal that's basically due diligence and the whole deal's fallen over because of it?
Yeah. I don't think it was financial diligence, but it was during the legal diligence. So it was to do with health and safety. So that particular, so it was a £50 million transaction. On the larger side, but a PLC buyer. And on the legal diligence, there was an issue with asbestos and I guess, way it being dealt with. And whilst, that's something that can be, rectified, I think, there's, and I guess this kind of highlights, the importance of DD, but because of PLC buyer, they weren't willing to take the PR risk on it.
I do think PLC buyers make due diligence, and I'm not saying it's for anything other than good reasons, but the due diligence process with a PLC buyer is more in depth.
It's full on.
Yeah, even with tax things. So if we come up with a tax issue, they might say, well, this needs rectifying, whereas a limited company might just say, well, we want some sort of retention or something until we're outside of the inquiry period. Whereas for a PLC, they'll often sort of say, well, we can't be seen to be what's the phrase I'm looking for? Facilitating tax avoidance.
Yes,
and therefore,
and therefore they
has to be rectified.
Well, yeah, and I think all right, and I have seen that before actually, where, and I suppose way that owner managers businesses sometimes run their businesses, the way they run tax affairs is probably okay, but not the way that a PLC would run it.
Yeah.
But what a PLC, as you say, they prefer to do a voluntary disclosure.
Yeah.
Of that issue and make sure it's clean as can be, rather than take a view on it or.
So we do. I think we talked about covering what types of due diligence we have. So obviously PLCs are more in depth.
Yeah.
If it's a fairly friendly deal, which can happen, especially if, say, a customer and a supplier have worked together for a long time, you often see they're fairly friendly. Yeah. So the level of DD required is much lower.
Yes. No, that can be. I suppose where I see, I guess the least requirement for DD is what we call management buyouts.
Yeah.
Because the people who are buying the business actually are the ones who are running it, so they know it. So actually, the requirement for DD is probably the lowest, and then as you say, kind of the PLC is probably the highest end. And just coming on to a point, I guess, on types of DD. So obviously, I guess today's webinar is covering focus on financial and tax, but I think as you mentioned before, there are other streams of diligence which are important for acquirers and investors, and such as commercial DD, DD on the marketplace, legal, regulatory DD for their particular industry, if applicable. Sort of I guess a wealth management business is an example of that.
Yeah.
So there are specific kind of streams. So I guess it might just be worth us touching upon, I guess, as this is about financial and tax, touching upon, I guess, why, I guess, why do people generally ask for tax DD? Because I guess sometimes I hear from, if I'm acting for a corporate acquirer and they're buying another business, sometimes the lawyers may say, oh, well, there's a tax covenant in the share purchase agreement, which basically protects you from any tax issues that might have happened pre-completion. It means that you can have a pound for pound come back to the sellers if anything should ever go wrong. So, why do you need to spend money on having tax diligence done?
Yeah, and people have different views of this. So the main point I think you touched on earlier is the fact that if you do the due diligence first, it's more comfort especially for the buyer, because anything that's raised, and PLCs will almost certainly insist on these, but anything raised before the sale goes through can either be rectified or it can affect the negotiations.
Yeah.
So if you take your example of, the health and safety one's not great because it's not tax or financial, but if you take an example of something that kind of is a skeleton in the closet that is a fairly significant value.
Yeah.
So let's say you're doing a £5 million deal and you pay £4 million up front and there's £1 million earnout or something like that. What happens if you find a £2 million problem?
Yeah.
Then it's not just that you're not going to pay your £1 million earnout, you've got to come back to them for £1 million.
Yeah.
And what happens if they spend it? I
suppose we came across a similar issue actually on one of the jobs that we worked on in October, where there was a potential issue, not a definite issue, but a potential issue with some property that was classed as stock. And
another one.
And there was a question about whether it should have been stock or whether it needs to be reappropriated, and the valuation of that particular land could have would have been in the region of millions, and therefore actually the tax liability associated with reappropriating it would have been 1 to 2 million potentially.
Yeah. Well, just to very briefly explain this, because this isn't technical.
Yeah.
But the reason you're mentioning the stock and appropriating to fixed assets is that for tax, the tax rules say that if you appropriate it from one to the other, it's effectively a market value disposal. So if they've put it in the wrong place on the balance sheet and then you've got to move it to the other place, then you've got a tax charge, but you haven't sold it.
Yep.
And so how do you fund that cash flow?
Exactly,
And so it's not just about there may be a tax charge which you need to get a retention on. You could be running into cash flow problems for the company as well.
No, that's a good point. And thanks for stepping a step back and explaining what the issue was. So,
it's those types of things that even if you think maybe there isn't a problem, it could come to light. You've then got the problem of how do you get the money from the seller.
Yep.
And that could be a longer process than when the tax liability becomes due to HMRC.
Exactly. Yeah.
Hence cash flow problems.
Yeah. So
as well.
With these potential issues, I suppose it's advantageous to head them off. So if you're saying your purchase price, say, it would give you an example of 4 million, then maybe you kind of go, well, actually, we're only going to pay you it was 4 million with a 1 million earn out. But you say you can kind of say, well, actually, we'll take another 1 million as retention. So we still owe you 2 million because we know the total issue could cost us 2 million. Now, I guess that doesn't solve necessarily the funding issue per se.
No, but it de-risks massively for the buyer.
Yeah, it de-risks. So I guess, that 1 million they keep in hand, so that helps towards the funding. And then, would probably work with the buyer post-acquisition to get the most favourable outcome, because it gets to 2 million as the worst case. And, at the time comes it pay that 2 million, look at, various funding options if needs be. By that time, the profits of the business may have been enough to cover that because they were planning to pay the earn-out anyway. Yeah. So, I mean, obviously, with all these issues we find, it's very case specific on how what the solution is.
I was thinking maybe we should talk about the process of due diligence, but I feel like we're going into some of the specific cases. So, shall we talk about the process, and then we'll talk about some common things that we often come across between us. Okay, so before we get into what the process is on an actual deal, I think it's important to highlight that you don't have to wait until the deal to do a due diligence process.
No, that's very good point.
And arguably it's beneficial not to wait that long. It can take a significant period of time to rectify certain things, especially if you need legal advice. So doing a sort of pre-transaction due diligence where maybe 2 or 3 years even before.
No, I'm a huge advocate of this. This is what I tell a lot of, recommend to, I suppose, a lot of clients who I guess would do what we call a friendly DD piece. Yeah. Where I guess, we basically give the questionnaires that we would normally ask during diligence, see what the responses are, see where there's weaknesses. And rather, I guess, than doing a full-blown report, I guess we do a checklist of areas that, could be changed or rectified ahead of sales. So
you're effectively acting as if you were acting for the buyer,
exactly.
Aren't you?
Yeah, kind of we're looking at our client as if I guess we're acting for the buyer and kind of saying, well, this is what issues that we would, have come out with. Yeah. So I suppose on the tax side, it's a bit more sort of, I guess, checklisty. On the financial side, what we look for is availability of information and, how detailed that is, because buyers will normally want to have analysis by, maybe sales type, by customer, etc. And it's just sort of seeing, how available that information is and how easy it is to pull off, and whether it reconciles back to the accounts. Because what you want actually when you're selling a business is to present, a picture of a well-run business with good records, and that all helps with the value proposition. Yeah. I guess being able to tidy up, I guess those sort of any sort of bookkeeping and reconciliation issues, prior to sale, certainly helps. I think the other thing that we also touch on is working capital management. So, we do quite detailed analysis of working capital trends on a monthly basis and daily cash use. Because that's normally sort of a price adjusting mechanism in most deals. And so we look at areas that, maybe they could work on in their working capital cycle to improve the price at the end of the day. So it's really quite valuable. One for, as I say, putting right any issues, and two for kind of, that value.
Maximising the value on the sale. Yeah, I think what a lot of people don't appreciate, and sometimes it's difficult as an advisor to fully appreciate it, is the amount of stress that is often incurred when you're actually selling a business and going through that process. So if you haven't done the due diligence and all of a sudden more things come out of the due diligence process that you've then got to answer, you've got to disclose, you've got to go back into negotiations on the price. Do we do this as a retention? Do we cover it by a warranty? All of these things. And it's not just the fact that it's the stress levels, and often you're trying to meet some sort of target completion date. But you're then probably going to be paying solicitors to have these negotiations with the other side, and it gets very costly as well.
No, and you're absolutely right about, sort of the pressure actually when a deal's on, because I guess not only are you doing your day job, running the business, the business owners, you're doing your day job, but you've been asked questions by the lawyers and the legal diligence. You've been asked questions by the buyer's accountants and the financial diligence. If there's any other streams of diligence, and like regulatory or kind of processes or IT, you're being asked questions about that. And so if you've done a bit of friendly diligence before and you've been asked these questions before and actually you've got some answers ready, one, it helps streamline. But two, also, as you say, if, there hopefully should be fewer issues that you come across during the process that, I guess, add to those stress levels. Because as you say, you're running the business, you're answering the DD questions, you're kind of dealing with any negotiation that comes out the deal, and also I guess the emotions of selling a business that you've
that's the thing, it is an emotional thing. Most people we deal with have run this business for normally decades, and so some people it's been their whole life, and all of a sudden they're giving it up, kind of thing. So we've got to having that pre-transaction due diligence, whilst it's not as costly, because as you say, it's more of a checklist style. We're not giving a full report, so that they're not having to pay huge amounts when there's not a deal on the table. And then it significantly simplifies the entire sales process.
Well, it's I guess it helps streamline the sale process and also enhance value and any stumbling blocks. So I guess in terms of process, if you had a client or corporate acquirer instructing you a bit of tax DD, how long for you would the process take, and what would it look like, and what would the output look like for the clients?
It can be quite variable. Normally, a tax DD needs to go quite quickly, because obviously there's lots of different factors involved in getting a completion over the line. So you're normally asked to prepare a tax DD normally within 2 weeks if it's an urgent thing, I would say.
It sounds about right.
It can be longer, and I guess what normally happens is you're asked to prepare it. Okay, so here's a checklist. We need all these things answering. I mean, it depends which side we're working on. So let's assume we're on the buy side.
You're working on buy side.
So we would say, here's a checklist. We need all these things answering, and sometimes that checklist looks quite scary because there's
and you're sending that checklist, I suppose, to the sellers or the sellers' advisors to fill in. So yes, there's a lot of questions on there. Some of those things, whole sections can be not applicable. There's a property section in there, and maybe they don't have any properties, or there's some things that, like for instance, DOTAS, which is tax avoidance, almost always comes back, no, we have not done any tax avoidance kind of thing. So some of them are quite easy to answer, but then some of the others, capital allowances is often quite in depth. Especially if they're properties as well. Employment-related securities is another reasonably in-depth one. And the other problem with those checklists are they ask questions
as if you have some understanding.
Yeah.
You know, if I said to any business owner, what's an employment-related security, they might have an idea.
Do you find it's easier then, rather than sending the checklist, to maybe have a call or a meeting, or just, actually face-to-face to actually run through the questions and actually ask, actually explain what it means and actually maybe give some practical examples, and then they go, oh yeah, so we gave so-and-so some shares. And, that's actually an employment-related securities, because that was an employee.
So normally I would say, here's the checklist we need to complete. And then maybe have a half-hour call once they've had a chance to look at it, and they can ask questions as to some of these things mean. Some of them are obvious, and some of them are a little bit more technical, and you need to actually understand what we're trying to get at. And then obviously part of our job is actually, okay, they've answered that question, but is there anything that stands out? As you said, employee shares. So they might have said no because they don't understand what an ERS is, and we look at the share register and say, yes, you have. So we need to go back and look at it.
That happens. I think that happens quite a bit. I suppose actually the process that you're describing for the tax side is, obviously very similar to the financial diligence side. And I suppose actually what we do goes hand in hand. And normally when clients do ask for financial DD, they also mean that they want to have tax.
It's normally financial and tax DD.
Including that. So we've got, not to reiterate old ground that you've just gone over, but, we would do very similar process, and the time tames are variable depending on the client and when the completion date is. But I suppose kind of the shortest time frame is probably 2 weeks really, from start to finish.
I mean, at least if you can set that 2-week deadline, there may well be more questions that come out, and you need to cover those in more detail. So things extend, but you generally don't want the tax and the financial DD to be holding up a major deal.
Exactly not.
So
and I think with our process as well, maybe more so, similar level to the tax, but actually be able to talk to the target business or the owners and understand, why the numbers are doing what they're doing, and actually understand why the business works and relationships with the customers, and actually, all the business aspects. Rather than just sending an information request list and getting a bunch of numbers, actually trying to get under the bonnet and understand them actually is key to the financial
I think
side.
You're absolutely right. And I think to help the process, having open communication, I mean, as well as I do, normally on a deal, when it's sort of getting into sort of the nitty gritty of it, you're probably having calls at 7 o'clock every night to kind of cover everything, because that's when the business owners are available, not in their day jobs.
And that's the thing, we kind of flex the time, because they might want to do if you do a site visit, they might want to do it out of hours when the employees aren't there. And kind of service provides it very flexible, and I guess in terms of output, probably for both of us, there's a written report for the client, but I think more so than that, I guess what we aim to do is actually have a verbal dialogue with the client as we go, and actually, as soon as we find an issue, we're discussing it with the client, and ways to kind of start to head it off before ahead of a formal written report. And I think what we try to do as well is actually give some advice and recommendation around, we're not just finding issues and then that's it. We're leaving.
Wash our hands of it.
We're kind of saying, well, in the past we've seen it dealt with like this, and what we're kind of trying to highlight, what's a potential risk to the client in terms, I suppose, quantum likelihood, and therefore they can take a view, or we can help them take a view on how to mitigate that risk.
I think those reports, we do different levels of reports depending on what the client actually wants, and obviously it's slightly dictated by the time frame we've got. Normally our reports, although they might go into quite a lot of detail to help a client understand what we're doing and what we're looking at, it normally ends up with, here's a traffic light system of here's high risk in red, here's amber that probably is going to be an issue, and then obviously anything that we've looked at that's no risk at all. So that, I think that kind of a detailed report can be useful, but the summary of this is what's important.
Absolutely. Essential. And I guess you say we've got you've got levels, so we can have a high-level report, as you say, that are just kind of traffic light. Even in the detailed report, we'll have that at the beginning, like the executive summary, so people can see at a glance, I guess what the key issues are and what the key trends are. There's probably some aspects of financial DD which maybe can't be done by traffic light, but more talk about key trends and things, because sometimes as part of DD we do more detailed analysis to say sort of profit margins by product type, and sometimes that can raise some interesting insights for the buyer into the seller's business, and actually things that maybe they hadn't thought were as profitable, or product lines that maybe need a bit of work on, or where maybe there's extra synergies that they hadn't thought of because they've got more buying power on that particular raw material or coming in. So they can make more margin in that particular product line.
So I think that's actually interesting, because I think generally you'd think of a tax DD as being quite a historical thing. So you just look at, okay, what, as we've already used the term skeletons in the closet, and that kind of draws the line, and then obviously any other tax issues going forward is the buyer's problem. Whereas with what you're doing, you're not only doing historical kind of analysis, but you're also saying, okay, well, actually, what value can you add?
Exactly.
So in effect, you're adding more value for the client than
potentially so. I mean, coming to, I guess, extending on the process and why do DD, I guess it's just worth maybe covering a bit of what we covered during financial. So say there is sort of that checking things and making sure that there aren't the skeletons in the closet sort of approach. So we look at balance sheet and see whether the assets are what they say they are, and how they're being valued, and whether they're being valued in the appropriate way, and whether things are in the right place. But also a key part of that is actually understanding, is there anything in the business that's not on the balance sheet, any hidden liabilities that perhaps the buyer needs to be aware of that's not on the balance sheet. So that's kind of so sort of your historical looking, and you also historical looking on the profit to make sure the profit that's in the accounts is actually what they're genuinely making as an underlying profitability of the business, and that's probably most times that's what they're based the price on. Guess what? But you also, as you say, we're also looking at the and the other thing, is probably is to look at the finance team itself, actually assess the quality of information coming out. So whilst we do the diligence process, we obviously talk to the finance team of the target, we get information from them, and you can actually get an assessment of how good the existing finance team is, and what the buyer might need to do post acquisition to improve, or whether it's fine as it is. But there's an assessment of strength of the financial team and the information they produce. But as you say, then there's also I guess what we call the quality of earnings piece. So we go, what is the underlying profitability of the business? And how sustainable is it? How much of their income is recurring? How much customer churn do they have? And we can extend that to a forecast review as well. So the business may have forecasts. So it's kind of feeding through everything we've found in the past and all the stats and everything, and making sure that their assumptions going forwards mirror that, or if they've got different assumptions, understanding why that is. There's quite in that sense there is a bit more of a kind of a forward-looking piece. Which
is quite valuable, I think, in a lot of cases. Okay, so we've covered what DD is. We've covered, I think, quite a bit about the process of what we do. Should we talk about some of our common issues? Because I think a lot of people will be interested to think,
that would be a good place to start. And I guess any war stories. So, I mean, we've already shared a couple of examples, but so I mean, kind of, I suppose on a tax point of view, I suppose where do you normally find you come across issues on tax diligence?
There's a few very common ones. So employment-related securities, which I've already mentioned. So that extends not just to have you given any employees shares, but also to share option schemes. Lots of SMEs might have issued EMI share options. So some of the ERS things there's always a question of, have 431 elections been signed? Even if you don't know what a 431 election is, you probably heard of one if you've been in any way involved in this kind of process before. So a 431 election is basically, if you issue shares to an employee, a 431 election allows you to treat it as if they're not restricted in some way. Because the tax treatment for restricted securities says the employee's taxed at on the restricted security when they receive it. So if they pay that value, there's no tax. But when they come to sell it, if there's a difference in the restricted and unrestricted value,
they just pay the tax on
that, even though you're selling shares and you think, oh, it's all capital gains, some of it could still be subject to income tax, which is quite a risk for a buyer, especially if that should be subject to PAYE and national insurance.
Exactly, yeah.
So that was a very brief overview and trying not to get overly technical with it. But the point is, employee shares, even when they're sold, could still have some income tax consequences. So we need to be quite careful. 431 elections are the type of thing that suddenly appear in a director's drawer because you make the election. It's a joint election between the company and the employee when they get the shares.
Yep.
They've got to make it within 14 days. So it's quite important. If you don't do it, then that's it kind of thing. However, it doesn't go anywhere.
Yeah.
So when you say to a client, when you kind of explain what one is and you say, well, you won't have submitted this to HMRC, you just have to sign it and keep it. A couple of days later, it's like, oh, yeah, here it is.
Yeah, no, it's interesting that. But yeah, no, I'd agree with you because I suppose, I suppose actually on deals that I've done, I found that actually tends to be quite a few issues on the, employment related security side. So I'd say EMI schemes is one where, incorrectly implemented EMI schemes or problem with the documentation.
Let's share war stories on that one, for instance. So EMI share options are, I think, quite a lot of people advise on them, but if they're not done properly, and also the process of notifying them to HMRC and things, it's so stringent in the legislation that just getting one thing wrong means the whole EMI option can be invalidated. And then instead of having an employee's got EMI shares, they're expecting to exercise them the day before sale and they'll get some of the proceeds. It's all capital gains, happy days. If you don't get it right, if either the EMI share option is wrong, if you haven't notified it within the correct time, all of these things, that value or those proceeds that the employee is expecting to receive, instead of being subject to capital gains tax, probably at 10% even, all of a sudden it's subject to income tax at possibly 45%. So the value, and so one of the recent deals we did, or one of the deals leading up to the budget, employee issued share options. The exercise price was 2,000 and he was going to get 300,000 as part of the deal. So day before sale, the intention is we exercise those options. He gets the shares. He pays £2,000 for those shares. And the next day he's going to get 300 grand. So 298 grand in profit, pay 10% tax, and he's going to net himself, what the figures, 260 odd. So, it's really tax beneficial. The problem with that one, it wasn't notified. So it used to be those had to be notified to HMRC within 92 days. It wasn't. Sometimes we get away with that because we then write to HMRC and say, oh, they relied on their advisor didn't do it. Can we have a reasonable, can you agree this is a reasonable excuse and let us notify it late? And HMRC, even though strictly they say that's not a reasonable excuse, they can be quite lenient on that. So that can be okay. But again, talking about the process, how long is it going to take to actually write to them?
And you don't want that stress necessarily while you're doing a deal. And I guess that's coming back to the point we made before about actually doing something a couple of years before a deal and maybe rectifying these issues when you're not under the time pressure is
really
key,
important on stuff like this. But the other problem that they had a side agreement. So they did the EMI option. Then they had a side agreement that said you're going to get 300 grand. So with an EMI option, you're saying the value when you issue it is 2,000. And it just so happens that the value increases because of minority discounts, all of that stuff. The value is 300 grand when they sell in 4 or 5 years' time. Here, their agreement just said you are going to get 300 grand. So the value is no longer, it's only 2,000 when you issued them. So that basically just invalidated the whole thing.
That's
that was that. So in that case, it was it's completely invalid. They can have their 300 grand, but they're paying 45% tax.
There's
nothing you can do about it at that point. And again, if you're properly advised at the time, to start with, you would say you can't have a side agreement. And so it's just about getting things like the process right, because EMI options are so regularly done wrong.
And I think coming to that, I guess what I see is it's the tax risk to what people think they're going to get, and therefore, people are obviously upset. But it's also kind of, I guess, delay to the deal happening, because whilst these issues are talked about / rectified, a deal that was maybe meant to happen in, December is now happening in April, May the following year, because they're having to either sort the issues out or get people comfortable with, what the new position is, and trying to get people on board with that who, thought they were in line for that 300k at, say, CGT, but they're having to pay income tax now. It's like, are the owners having to give them a higher amount to give them the same net amount?
Yeah, I mean, that's the thing, isn't it? Like the owners who are getting millions, for them it's they're still getting their millions, but normally an EMI agreement will say any tax liability is a responsibility of the employee. Yeah. So the employee who, 300,000 is life changing to a lot of people, but it's not millions. It's not. It's not sort of a retirement plan. No. And so if they're all of a sudden you say, well, you thought you were getting 300, you're only getting 150. That's
it makes a big chunk. Big difference.
It's not like you're getting 10 million and actually there's a bit of a retention, so now you're only getting 9.5. It's still. So EMI options are something that really need, when you're implementing them, get proper advice, and when you have them, if you're looking at selling, make sure you're comfortable that there's no issues with it either.
I suppose the other thing that I normally see tax diligence being quite important on is when the sellers are doing some restructuring prior to organisation. So, for example, they might have a property that's in the business that they want to put into a personal name, and they're doing, I guess, what we call a demerger to take it out, or they're separating a division somehow. It's important to make sure that, I suppose the steps they've gone through are correct.
So we do a lot of pre-transaction demerger work. In fact, reconstructions are probably the main thing we would say we do. So the issues with that is, firstly, clearance. Most buyers are going to want to see that clearance has been obtained. Even if you've done this a few years ago, they'll ask, can we see a copy of the clearance? And then they'll compare that to what was actually done. Have you done what you said you would do to HMRC, or actually has there been a material change from the clearance to what ended up happening? Stamp duty issues. So if you do it too close to the sale, HMRC might well charge stamp duty on it, because they don't like giving Section 75 relief if there's a deal on the table generally.
And then that's a negotiation point for the advisors to see, who suffers the stamp duty liability.
So there's all of these kinds of things that, and getting clearance, if you're doing it. So if we say we'll do a friendly DD 3 years before, and you say, oh, actually, you want to sell this part of the business and you want the properties in there as your retirement plan, then if you do it and you say at some point in the future we want to split this out, it's easier to say to HMRC, we're doing this for commercial reasons, we're setting the business up with a view to getting it sold and to maximise value. That's a good commercial reason. And HMRC will probably be fairly comfortable in giving clearance. If you go to them and say, we've got a deal on the table, we've signed heads of terms, we're looking to sell in 2 months, we want to get this property out because we don't want to sell it, HMRC are likely to be a lot more difficult in getting clearance, because the alternative is, well, instead of demerging and paying no tax at all, take it out as a dividend now and pay 39.35% or whatever the figure is. So there's other ways to do it that's a lot more costly from a tax perspective. And so, again, you need to kind of think about those types of things a long way in advance, because demergers don't normally happen any quicker than sort of 3 months. And then you've got to deal with the sale afterwards. So.
Absolutely. No, it's always good to think about these things ahead. I suppose maybe coming to a few sort of, why and examples of why to do financial diligence. I suppose one of the key things that we also look at part of financial is the working capital of the business, and and the balance sheet, and what's called cash-like and debt-like items, aside from the obvious, bank loans and cash at bank. So I guess this is quite key, and I suppose one example, a key thing of the diligence is agreeing that working capital target, and it's very important for the buyer to get that right, because they need to make sure they've got enough working capital to run the business going forward.
Yep.
So most deals that we do are done on a normal working capital basis. So the diligence will identify, I suppose, what that normal level working capital is. I mean, it is open to negotiation, but actually the detailed work that goes into the DD is a very good starting point for that. I do find that, I suppose, in a lot of deals that, or the diligence that we do is actually kind of the work that we do and the working capital and the analysis we do there and the suggestions we give on, a range of working capital targets is we find that a lot of buyers actually do end up using that work.
Yeah.
Or, or actually use us afterwards to negotiate on their behalf, having employed that work. And, there can be a lot of value gained and lost there. So, for example, I suppose, as a buyer, you're kind of looking to set that target maybe higher, and as a seller, you're looking to set it lower. But for example, one of the things you could pick out is stock valuation, and are they valuing stock in the right way? Are they have they been valuing all the stock, or and how they valuing their work in progress?
Do you do anything much with obsolete stock in terms of they might recognize, let's just say they do FIFO basis of stock valuation, and actually you go and look at it and there's a whole 100 grand's worth of obsolete stock that they've actually not provided for. And
so I mean, obviously what we do is we do analysis, well, not obviously, but we do analysis of the stock and kind of the aging profile of stock. Right. And probably on a line-by-line basis. And what we probably do is work in tandem with the buyer, and obviously their knowledge of those products and the raw materials, and actually is that product line still a live one, and we can look to see, and looking at the aging, you can probably tell, because if something's within 6 months and it turns, it's normally good. Yeah. But if it hasn't moved for 6 months, a year, 2, 3, 4, 5 years, and then there's questions about that's definitely slow moving stock. Is that obsolete? And you can kind of see most businesses will properly provide it against them, or have a kind of provisioning policy that increases in percentage as something ages, and we look to see whether that's reasonable. And I suppose actually what we're trying to do is get a consistent policy between that and then how it's valued at completion, and that's part of the process. But as long as that's reasonable and we're doing a consistent, as long as there's something consistent, that's the key point. I guess the other thing to point out is kind of actually, I suppose, looking at creditors and genuine creditor suppliers. So you when you look at their terms and conditions with suppliers, they may pay their suppliers in 30, 45, 60 days. You may have one creditor balance which is 120 days old, or it's not being paid for a few years, or is always a high balance. So and it's kind of getting to the bottom of the arrangements there, whether they're commercial arrangements or whether that particular supplier is got some sort of interest in the business, and therefore they're almost sort of propping them up by giving them a higher line of credit. And and the question is that genuine working capital, or is that funding of some sort, and do we need to treat that as a debt-like item, and therefore if you're a buyer, it comes off the price. So these are kind of quite key sort of value adjusting items.
Is it worth us just mentioning because most deals you were talking about working capital and things, worth mentioning, I think, what we mean by sort of a debt-free, cash-free basis, because most deals do complete on that basis, don't they?
That's a very good question. So I suppose, so a lot of deals that we do, the offer's made and it's made on the cash-free, debt-free basis. So that doesn't mean, for example, in the in other jurisdictions, that actually might mean cash-free, debt-free, i.e. you have to take out all the cash and you have to pay for all the debt prior to selling your business. It's not in the UK, that's not the case. So what cash-free, debt-free in reality means is that if you've got £1 million in the bank at completion, then that will probably be added to the price. If you've got £1 million of bank loans at completion, that would be taken off the price. And the guess is so that bit's relatively straightforward. There's a bit of nuance around the cash. So part of what we look at around the cash is actually your day-to-day trading requirements.
So this is your working capital requirement, basically.
Yeah, so we do kind of your working capital requirement, but on top of that, we also look at daily cash requirement and daily working capital requirement. So any sort of working capital analysis that we do is probably on a monthly basis, whereas we will look at, bank statements for like the last 6 to 12 months and actually analyze trends in when the supplier payments go out and when the customer payments come in and all that, to understand really, I suppose, what level of cash actually does the business need to run.
Yeah.
And so actually when we say cash free, a lot of times for the buyers, we do like to say actually that surplus cash,
yes,
not all cash.
Yeah.
I mean, obviously you're a seller, you ideally want all cash, but a business needs a certain cash buffer to run, whether they have an overdraft facility or whether, they don't, and there needs to be a cash buffer in the business. So, the diligence work covers that and actually gives a figure that can be negotiated. And that's a real, price adjusting item for
so what normally well, there's a couple of mechanisms, isn't there? There's completion accounts mechanism, which is I think by far the most common, or certainly that I come across. So what that means is you negotiate your deal, you then say excuse me, let's say the deal's £5 million debt free, cash free. So if there's any excess cash, or as you say surplus cash, that's added to the value. So let's say there's £1 million of surplus cash, the deal is actually £6 million. But you can't know the working capital figure until on the date of completion. So you normally have a specified period of time in the share purchase agreement that says it's normally 1 or 2 months, isn't it?
That's it, right?
By that time, the accountant has to prepare a set of completion accounts saying exactly where you were at, agree that, and then the balance
that forms the working capital adjustment. And sometimes what we'll have is maybe have an estimate of that working capital is. So maybe like we'll have the accounts 2 months before completion, and we'll do an estimate of working capital, what the working capital is at that date. Then we'll do what we do. The completion accounts are true up the figure. So it'll be, what actually, as you say, what was working capital at completion, and then we'll do an adjustment to that.
Yeah.
Coming to debt, then I suppose one of the key things of doing diligence is to identify, aside from the obvious items like hire purchase or loans, what else is debt like. So it's been, for example, as I said, like those unusual trade supplier arrangements that maybe are more debt like than they are proper supply arrangements, but and any sort of off balance sheet sort of liabilities. So one of those might be dilapidations. So if you're got a lease with a landlord and it's coming to an end in about 3 or 4 years, not all businesses will have had a dilapidations provision. And so what you might have is someone come in here to sort of survey the building and actually go, well, actually, if I were a landlord, I'd be saying, I want you to put this, and this right. And, start to accrue for those kind of provisions. Another kind of key area that is debated around is, I guess, deferred tax, I suppose, which people might say is tax diligence, but it's more of an accounting entry.
Oh yeah, don't ask me about deferred tax. It's not a tax problem.
But we do have in deals there are debates around that, and what diligence can help to do is, I guess, identify what that deferred tax relates to, and therefore, should it be classed as debt and should it not? I mean, a lot of sellers obviously take the view that definitely not debt because it's not tax that's payable, and it's it's an accounting entry. But I'll maybe give one example where I suppose I did a deal for a client on the buy side, and we had deferred, or certainly an element of deferred tax as debt. And so deferred tax, just as a quick background without getting too technical, I suppose, is normally comes when a business claims annual investment allowance. And so what the accounting treatment is trying to do is saying, well, if they didn't have that relief all in year one, it would have been spread over years 1 to 10, say, for example, for the life of the asset.
So I think, so just to say so capital allowance is a big one, property is the other one. Basically, it's saying if you were to sell the asset today for the value it's shown at on the balance sheet, would you have a tax charge? And then you recognise that as a provision. So if you're selling a property, for instance, you bought it for 100 grand, it's sitting on the balance sheet at £1 million. Obviously, you've got indexation allowance, but effectively, you can have a £900 grand gain, 25%. That's a deferred tax provision.
Thank you, Nick. And
so I do know
it's helpful to have a tax person in the room. I mean, I suppose if your business is constantly investing in assets, it might have £1 million deferred tax liability because it's continually investing in assets. But in this particular case, actually, the business had just done a huge investment spree, and actually, our buy was actually part of the consideration was paying for that.
Right.
Paying for that.
Yeah.
And so, the very fair and genuine argument that we had is actually, well, the price that we're paying includes that investment that you've made.
Yep.
And therefore, any sort of, capital allowances that you've been able to claim in it shouldn't actually be for, the benefit of the sellers.
It's very case by case, isn't it? So, and with a property, for instance, you might say, well, you're not going to sell that property, probably, for decades possibly. So why would we say that this is this tax is a debt-like item? So
there's definitely arguments both ways, but what diligence helps to do is discover, why that deferred tax liability is there, and therefore how it should, feed into the deal dynamics. So,
okay, I think we're running out of time, to be honest.
Yeah, so I think we're coming towards an end. I think that's hopefully helpful. People watching, share the field war stories, what due diligence is about. Hopefully you've been dropping any questions in the comment box as we've been going along, and say thank you for Nick for joining me today. And I think that concludes our webinar, and we'll come back to any questions you have via email or afterwards.
Thank you.
Thank you for watching.